The Public Provident Fund or PPF is one of the most popular saving vehicles in India. One of the reasons for this is the tax benefit it offers as it comes under the EEE Exempt-Exempt-Exempt tax status. What this means is that at the time of investment, the interest earned and proceeds received at the maturity are all tax exempt or free. Now, this is a fact that a lot of us know about, but there are a few things about the PPF that not many of us people are aware of. Hey guys, this is Prarthana from Clear Tax and I will be sharing 5 lesser known rules for PPF accounts. Number 1, you may get more time for investing. In the case of most financial investments, the calculation date for maturity starts when you start your account or make the first payment or deposit. But in the case of PPF, the 15-year lock-in period is calculated from the end of the financial year in which it was opened. This effectively means that you may get additional time if you begin your investment in the middle of a financial year. Number 2, you can time your deposit to earn more interest. In a fixed deposit account, the interest calculation on the amount deposited starts immediately. However, in the case of PPF accounts, the balance amount considered for interest calculation is the minimum between the 5th of the month and the month's end. So, if you are planning to make monthly deposits in your PPF account, you should do so before the 5th of every month. This way, your account will have a higher balance and the interest will be calculated on that, fetching you a higher return. Number 3, you can borrow as well as make partial withdrawals. Even though PPF has a lock-in period of 15 years, investors can make partial withdrawals and avail of loans against PPF account. All you have to keep in mind is certain conditions. For example, up to the 7th year, you can take a loan for which you will be charged an interest rate that is 1% higher than the PPF interest rate. From the 7th year onwards, you will be eligible for partial withdrawals but not for a loan. If you have taken a loan, you can still make a partial withdrawal after 7 years provided you repay the loan outstanding amount along with the interest before availing of the withdrawal facility. Number 4, you can operate your PPF account even as an NRI. Any resident citizen of India can open and operate a PPF account. NRI citizens are not allowed to open a new account. But if they have an existing account that was opened while they were a resident in India, they can continue to operate it. That is, make regular deposits till the 15th year maturity period. Lastly, only you can access your PPF money. One of the best features of a PPF account is that it is safe from a debt recovery process. Even in the case of court orders ordering attachment of assets for repayment of debt owed, an individual's PPF account is exempt from such an order, thus guaranteeing him or her some income. So, do you have a PPF account and were you aware of these rules? Let us know in the comment section below. Also, do not forget to give this video a big thumbs up and subscribe to Clear Tax's YouTube channel for regular videos on finance. Stay tuned, stay happy and take care.